Welcome back to The Explainer. Today, we are tearing into a pretty fascinating mystery that's unfolding right now in the retail sector. We're looking at a 168-year-old legacy brand pulling off what some might honestly call a miracle on 34th Street. We are, of course, talking about Macy's. Now, if you're a potential shareholder or just someone who closely tracks market momentum, you've definitely noticed their stock soaring recently. But the real question is this a genuine retail renaissance, or is there a major catch hiding somewhere in the balance sheet? We're going to thoroughly analyze Macy's current financial performance, check out their quarterly earnings, and see how their market position stacks up, especially when we contrast these optimistic stock price trends against some notably cautious analyst readings. Okay, let's dive into this. Here is our roadmap for today's explainer. We'll start with Macy's hitting new highs, then we'll unpack their bold new chapter, look at Bloomingdale's totally stealing the spotlight, examine the Wall Street disconnect, dive into the margin story, and finally, we'll weigh the bull versus bear case. Let's kick things right off with Section 1, Macy's hits new highs, the momentum. Because right now, that upward momentum is absolutely impossible to ignore. Boom, $24.70. That is Macy's recent 52-week stock high. On the day this was recorded, the stock leaped a massive 7.2% in a single trading session. To put that into perspective for you, over the last 12 months, Macy's has delivered a total return of over 81%, massively outperforming the S&P 500's 30% return over that exact same period. And listen, this isn't just hype. This upward trajectory actually reflects their fourth consecutive quarter of comparable sales gains. The foundation of all this momentum, it lies right in their Q1 2026 fundamentals. Macy's basically beat analysts' expectations across the board. Net sales nudged up to $4.7 billion. But the real driver of market optimism, the thing everyone's looking at, is that GAAP earnings per share jumped from 13 cents all the way up to 23 cents. They blew past estimates and proved their profitability is improving right alongside their revenue. Honestly, this is their strongest first quarter same-store sales performance in 4 years. And you know, when a company beats expectations like that, the heavy hitters, they definitely take notice. The company has a really healthy quarterly dividend of just over 19 cents per share, which gives it an annualized yield of about 3.1%. That reliable payout, combined with a pretty low starting valuation, attracted none other than Warren Buffett's Berkshire Hathaway. They recently acquired 3 million shares. Buffett even casually mentioned back in March, got one tiny purchase. When the Oracle of Omaha is quietly buying into a department store, you really have to ask, what does he see that everyone else is missing? Well, that brings us to Section 2, the bold new chapter, strategy in action. Because to understand those numbers, we really have to understand the strategy driving them. The Macy's of today is definitely not the Macy's of yesterday. Under the leadership of CEO Tony Spring, who actually took the helm after spending nearly 4 decades climbing the ranks over at Bloomingdale's, the company has launched a major corporate restructuring aimed straight at capital efficiency. Spring's bold new chapter roadmap is incredibly focused, and it boils down to 3 pretty ruthless steps. Step 1. Amputate the dead weight. They're closing 150 underperforming stores. That process is nearly 80% complete, and it immediately stops the financial bleeding while offering some great asset optionality from selling off that real estate. Step 2. Take that saved capital and invest it strictly into about 350 high-return, go-forward locations, what they're calling their reimagined 200 stores. And step 3, aggressively target the upper end of the K-shaped economy. That's where high-income shoppers are still spending freely, so they're leaning heavily into luxury and beauty. Which perfectly sets up Section 3. Bloomingdale's steals the spotlight, the luxury engine. Because if we're talking about luxury and beauty at Macy's, we absolutely have to talk about the true star of their portfolio. When you break down their comparable sales growth, a very clear narrative emerges here. The namesake Macy's brand grew a modest 1.6%. Their beauty store, Bluemercury, did a very respectable 6.4%, but Bloomingdale's, they saw a massive 10.2% jump. Bloomingdale's actually hit a sales volume record for the first quarter. This high-end department store is heavily subsidizing the broader turnaround of the entire parent company. So why is Bloomingdale's surging so much right now? Well, a lot of it honestly comes down to being in the right place at exactly the right time. Their major rival, Saks Global, which includes Saks Fifth Avenue and Neiman Marcus, is currently navigating bankruptcy court. Saks stores have literally hung everything must go signs in their windows. As a result, Ferragamo-seeking luxury shoppers are flocking straight to Bloomingdale's. As CEO Tony Spring noted, this disruption is adding serious fuel to the fire, allowing Bloomingdale's to aggressively snatch up both market share and critical merchandise vendor relationships. But as with literally all turnarounds, there is a catch. Welcome to Section 4, the Wall Street disconnect. The catch. I really want you to think about this question for a second. If same-store sales are rising, the dividend is yielding a solid 3.1%, and the stock recently touched $24.70, why in the world is Wall Street treating this stock like it's radioactive? Well, here is your cold reality check. Despite those bullish highs we just looked at, the consensus rating from analysts sits firmly at reduce or hold. Even more glaring than that, the average analyst price target is just $20.30, which is well below its recent peak. Wall Street is looking right past that short-term luxury bump and focusing on some massive, long-term secular headwinds. Basically, Macy's is caught in a brutal vice. They've got off-price chains like TJX squeezing them on one side and e-commerce giants like Amazon on the other. Add in the very real risk of a macroeconomic slowdown crushing discretionary consumer spending, and yeah, you can see why analysts are sweating a bit. To truly grasp Wall Street's pessimism here, we need to move to Section 5, the margin story, under the hood. The sheer scale of this profitability gap is exactly where the concern lies. Macy's operating margin is currently sitting at an incredibly thin 4.33%. Compare that to a broader market average of around 18%. Furthermore, their return on invested capital, which is essentially a measure of how well they turn their cash into actual profits, has fallen from a historical 17% down to 12.8%. What does this tell us? It tells us that while top-line sales might be recovering, the underlying business is incredibly sensitive. Just one bad quarter or a slightly need to heavily discount their inventory, and that tiny 4% margin completely evaporates. So, where is all that money going? Well, turnarounds are expensive. Their selling, general, and administrative expenses, or SG&A, hit $2 billion in Q1. That eats up almost 40% of their total revenue. Between the huge cost of remodeling those go-forward stores, paying out severance for the 150 closing stores, investing in new AI-powered chatbots, and taking a slight margin hit from recent supply chain tariffs, Macy's has an incredibly asset-heavy cost structure right now that is severely compressing their overall profitability. So, where does this leave you, the potential shareholder? Let's break down the final verdict in Section 6, the bull versus bear case, the final verdict. It all really comes down to weighing these two realities against each other. The bull case is definitely compelling. The strategy seems to be working, comps are positive, the stock looks incredibly cheap relative to trailing earnings, they pay a great dividend, and they are sitting on some highly valuable real estate they can sell off. But then you have the bear case, which is equally fierce. Their 4.3% margin is a structural failure compared to their specialty retail peers. Winning back market share in apparel against off-price and digital rivals is notoriously difficult, and any missteps in those store closures or just a sudden dip in the broader economy could absolutely derail the whole thing. Which brings us to our final thought. The numbers are undeniably looking better, but the underlying engine is still fighting a massive uphill battle. So I leave you with this. As an investor, do you look at Macy's and see a deeply discounted turnaround story just getting ready for its next big chapter? Or are you staring at a classic value trap in a fading retail landscape? Weigh the evidence, take a hard look at those margins, and decide for yourself. Thanks so much for joining me on this explainer, and we'll catch you next time.